will see our growth, top-line growth, really being propelled by Australasia, being particularly vibrant in Australia, also growing nicely in New Zealand. We've re-entered Hong Kong. So much of the growth coming from our Australasian operations and our mining operations. In South Africa, low single-digit growth, really reflecting the infrastructure market domestically. We'd obviously like to see that improving on the back of the government's infrastructure development plan.
So let's look at, of course, the bottom line, which is a completely different story right now in light of the tough margins that you're still facing. 64% drop in full-year operating profit to 535 million rand. That's from over 1.4 billion in the previous year. So it's certainly been a tough year when you look at the bottom line. Can you drill into the specifics in terms of those losses?
Yeah, look, I think the overall picture is that the rest of our businesses have in fact done remarkably well in the current circumstances. Our manufacturing and processing business margins have improved. In our open cut mining business, we've also seen a margin uplift. In Australia, on the back of addressing problem contracts, we've also seen an improvement there. The big elephant in the room for us this year has been South African construction, and in particular Aveng LTA, where we have seen huge losses there. That 764 million loss is really comprised of a provision for the Competition Commission, a steel fabrication project in respect of DSE and our DSE and Genrec. That's a matter that the market's known about. It hasn't been resolved, and so we've made provisions for that. We've had some smaller projects in South Africa that have taken some strain. We've also restructured that business. So there are a number of issues leading to that underperformance. But looking to the future, that's certainly the focus for us in the year ahead.
Are you hoping to recoup some of those losses from the Medupi DSE steel fabrication unit?
Look, with the DSE steel fabrication, we have a claim against Genrec, and we're going to pursue that claim vigorously. That'll go into, if we can't reach a settlement, it'll go into an adjudication process. And that will then be subject to the timing of the adjudication process. But certainly we believe we have a strong claim and we're going to pursue it.
When it comes to operating margins, falling from 4.3% to 1.3%, it really indicates where the construction sector is right now. How likely is it that this is the bottom of the margins right now?
Yeah, I think that the huge tipping point in SA construction is public sector spend. In our 47 billion rand order book for the next 2 years, 3.6% comes from the South African public sector. We'd like to see that improve. Our ideal mix in our book is a 50-50 public-private split. But in the meantime, we're going to fish where the fish are. So we're growing in Australia. We're applying capital there around PPPs and concessions. We will be investing 165 million rand in Mozambique in the coming year for a steel manufacturing facility. So, we're growing elsewhere. We'd love to grow more robustly in South Africa, and much turns on the infrastructure plan.
I mean, as you say, you're fishing where the fish are, and at this point in time, you haven't really seen the impact of that 844.5 billion rand infrastructure drive in South Africa. Is it wise for a construction company or any player that's putting their hopes on it to really be putting too much emphasis on it?
Look, I think as a proudly South African company with a global footprint, we're in approximately 30 countries at the moment. We'd like to be strong in our home market. So, and with that plan will come jobs, localization of industries, creating the infrastructure for the economic growth objectives that South Africa has. And so it has to happen. But in the meantime, you will see companies seeking work in other jurisdictions. And if you look at some of the major players on the JSE here, a big chunk of work is coming from outside of South Africa.
I mean, just looking at your order book, as you said, it's sitting at 47 billion rand. It grew by almost a third versus this time last year, June 2011. Where the big contract gains been?
Notably in Australia, where we've picked up some big projects on coal seam gas. In Western Australia, where we continue to work on iron ore projects. Some nice chunky social infrastructure projects as well. And then also in our mining operations. But civil construction has taken a lot of strain post World Cup.
How concerned are you right now about the fact that many miners have come out and cut their capital expenditure plans? What does that mean for the growth prospects of Aveng Mining?
Look, our challenge is to run a viable mining business through the cycle. 2008, on the back of the global economic downturn, we saw about 4 billion rands cancellations in our order book. That was all mining related. And so we're very alive to the fact that our mining contracting businesses are driven by commodities. We are across a spread of commodities, which hopefully provides us a bit of risk mitigation. But the global macroeconomy and specifically commodity demand, what's happening in China, these will influence the fortunes of mining and mining contractors.
So can you give us an outlook for 2013 in terms of key growth prospects right now? And is it likely that you'll be able to improve on the operating profit that you made during the period?
Look, we currently have, as we've reported, 47 billion rands worth of projects in our order book. If we take McConnell Dowell in Australia, that operating margin we're reporting is 2.4%. That's after taking provisions for some of the big contracts that are giving us some difficulties. If we resolve those and add back those numbers, we get into an underlying profitability of between 4 and 5%. So we're certainly looking to improve there. On Aveng LTA, we've restructured the business. We've cut 2% of the overheads there. Hopefully we resolve the Competition Commission and the DSE contract. We should have a better performance there as well.
And you'll continue buying back shares. You have been embarking on the share buyback program.
We've bought back shares and we keep an eye on the market in that regard.